So what really drives a stock's price? It seems like a pretty simple question, right? Well, as we're about to find out, the answer is way more fascinating. And honestly, a lot more counterintuitive than you'd probably guess. Okay, I'm sure you've seen this headline before, right? A company just crushed their earnings, they beat all the estimates, and then you look at their stock and it's tanking. It makes absolutely no sense. So what in the world is going on here? Well, to really get it, we've got to dive into the drama that unfolds every single quarter. I'm talking about the earnings report frenzy. It's this huge, almost theatrical event where it feels like the entire financial world just holds its breath, waiting for these companies to drop their numbers. And in this whole drama, there's one rule you hear over and over again like a mantra: beat the street. The story they tell you is super simple. Beat the earnings estimate, your stock goes up. Miss it, and your stock goes down. It's sold to us as like the #1 rule of the game.
Yeah, but if it was really that simple, we wouldn't have that confusing headline we started with, would we? So, what does the data actually tell us? Let's dig in and find out.
All right, this is where we're going to leave the headlines behind and get into the real numbers. We're going to look at a couple of studies that pull back the curtain on the deeper forces at play. The stuff that really creates value in the long run.
Okay, so check this out. This first chart is looking at almost 600 different earnings announcements, and it's trying to answer just one big question. After a company reports its earnings, what actually predicts whether the stock is going to go up or down?
So let's start over on the right side. That whole beat the street rule, it's not completely wrong. You can see right there that beating the estimate does give you a little boost. For example, look at that top category. Companies that beat estimates returned 2.4%, while those that missed only got 1.5%. So okay, there's a little bit of truth to it.
But, okay, now for the big reveal. Shift your eyes to the left side of the chart. This is the real story, right here. The single biggest thing driving returns wasn't what happened last quarter. Nope, it was the company's outlook for the future. Companies that guided for positive earnings over the next 2 years, their stocks went up. And companies that signaled a negative outlook, their stocks went down. And get this, it didn't matter if they beat the current quarter's estimate or not. The market cares so much more about where a company is going than where it's just been. Now, to build on that idea, we need to quickly define one more thing: return on invested capital, or ROIC. All it is, really, is a way to measure how good a company is. For every single dollar a company puts into its business, how much profit does it squeeze out? Just think of it like a company's financial report card. All right, this next chart, this is the real cheat sheet. It lays it all out for us. It shows what happens when you stack up a company's fundamentals. I'm talking its growth and that ROIC we just talked about against whether it's been beating or missing its earnings. Okay, so this chart tells the whole story. Look at the top left, a high-growth, high-quality company that beats estimates, boom, a 4% positive return. Now look at the bottom right, a low-growth, low-quality company that misses, a negative 6% return. No surprise there. But here's the real kicker. A high-quality company that actually misses its estimates still gives you a positive 2% return. Now compare that to a low-quality company that consistently beats its estimates. It actually loses you 2%. The takeaway here is so clear. A great business having one bad quarter is a way better bet than a bad business that managed to have one good quarter. At the end of the day, fundamentals are king.
Okay, so if we know that fundamentals are what really matter long-term, then why does it seem like the market is so obsessed, like totally fixated on the short-term earnings beat? Well, the answer comes down to one thing. There are two very different kinds of players in this game.
So on one side, you've got the intrinsic investor. These are the folks who are all about the long-term value of a business. They're digging into the fundamentals, and they plan on holding on to a piece of that company for years. Then, on the other side, you have the trader. Their goal is totally different. They're trying to make a quick buck off short-term price swings and momentum. Their timeline isn't years, it's more like days, or sometimes even hours. And when you look at the data on how traders behave, it's just staggering. A typical trader, their annual portfolio turnover is over 200%. Just think about that. That means they're buying and selling their entire portfolio multiple times every single year.
And the amount of money we're talking about here is just massive. A single large trading firm might churn through 88 times billion dollars in trades in 1 year. Now compare that to a typical intrinsic investor firm, which might be around 6 billion. The sheer volume of this short-term trading just completely dwarfs the long-term game. And that right there,
That is the answer to the puzzle we started with. It's that huge, massive volume of short-term trading that creates all the noise and all the crazy swings around an earnings announcement. The traders, they react instantly to the headline, and there are so many of them doing it that they just dominate the news cycle and the stock chart for that day.
So, what's the key takeaway here? It's all about learning to look at a company through these two very different lenses. You've got to learn how to separate that short-term noise from the long-term signal. Let's try to make this a little more real with an actual example. We'll call this company Fashion Co., and here are some of its key numbers right next to its competitors.
Okay, so now that you know how these two different types of investors think, take a look at the numbers here. How do you think our trader would view Fashion Co.? And what about our intrinsic investor? How would they see it?
Well, a trader might look at this and see a pretty boring story. The organic growth is only 2%, which is lower than some of its rivals. There's no big, obvious reason for the stock to pop in the short term. But our intrinsic investor, oh, their eyes would go straight to one number, that ROIC of 20.5%. To them, that is a huge flashing sign of a really high-quality, efficient business. They see a company that's fundamentally healthy, not just something to trade on a headline. You know, this whole thing just reminds me of that classic line from Warren Buffett. The stock market is a device for transferring money from the impatient to the patient. And that just perfectly sums up this whole idea, right? The difference between reacting to all this short-term noise and really focusing on long-term fundamental value.
So when you boil it all down, it's pretty clear. What a company says about its future matters way more than what it just did. And a company's fundamental quality, its real report card, is the ultimate driver of its value. So the next time you see one of those frantic headlines about an earnings beat or miss, you can ask yourself a much better question. Are you going to ask about the last 3 months, or are you going to ask about the next 3 years?